Hello, and welcome to our fourth quarter 2017 strategy session. We met here midweek. We had a guest on the phone, Andy Leckel of Eagle Asset Management, and to my left, Bob Toomey, Director of Research, and to my right, Len Skina, CEO and Vice President of the firm. We covered a lot of territory. We covered things such as North Korea. We covered other things which were more definitive on the economy, including the tax proposal, which is currently in the news. In any case, we did cover a lot of territory, so right now I'm going to switch it to Bob, and we'll cover a little bit more of the changes that we made, and we'll also talk about the idea of triggers, which we had before, but we've got two of them this time, so we'll cover that later in the presentation. Bob?
Thanks a lot, Stan. One of the key themes that came out of our discussions earlier this week was, I think, the idea that this environment continues to look very positive overall for a variety of reasons. It's something that I would call a Goldilocks environment. You've probably heard that term in the news media. What it really means is that the conditions for the stock market are not too hot, not too cold, but just right. We're looking at a healthy U.S. economy. We're looking at a very accommodative global monetary policy. Inflation remains low, and corporate earnings continue to look very good. Just as a quick follow-up on that, corporate earnings have been growing the last 2 quarters at a double-digit rate, and we expect that to continue going forward, and that really is a key driver of the overall stock market. With respect to Federal Reserve policy, that continues to be quite interesting and continues to be very accommodative. It was very interesting earlier this week that Fed Chairman Janet Yellen essentially commented that the Fed really doesn't understand what's happening with inflation or why it's remained so low. And that gives us some comfort, if you will, that the Fed's going to continue to be very deliberate and very gradualistic in the way they implement their policies. One of the concerns we have had that I've mentioned the last few quarters is valuation of the U.S. stock market. Right now, it's trading at about 18 times forward earnings, about 21 times trailing 12 months earnings, and that is above the average. But I would point out that stocks can continue to rise even though valuations remain elevated in an environment where inflation remains low and corporate earnings are rising. So I think overall, the environment continues to remain quite positive for U.S. stocks. I'd like to turn it over to Len now to give us an overview of the fixed income area.
Thank you, Bob. As Bob said, the Fed did come out this week and say that they don't really understand why inflation is so low. And that leads us to believe that the Fed is going to be a little bit less aggressive in terms of raising interest rates. That said, we still believe that the Fed wants to raise interest rates. They want to have some ammunition, and they want to have an arrow in their quiver in case something should come on and shock the economy somewhere along the way. And the only tool that they usually have is to play with interest rates. And if the interest rates are low, there's not a whole lot that they can do. So they're going to try to bring those up. We feel that the fact that they're a little bit concerned about not really understanding what's going on with inflation is going to make them a little bit less aggressive, but we don't think that it's going to have them back off entirely. And so we anticipate them still raising rates along the way. With them raising rates slowly at this point, it's going to affect bond yields. And as bond yields go up, bond prices are going to drop. And for that reason, we are continuing to emphasize the short end of the curve rather than the long end of the curve, because the short end is less interest rate sensitive. On the long end of the curve, to try to bring a little bit of additional yield into the portfolio, we've introduced a position this quarter in preferred stocks, which are a kind of stock bond hybrid, but that will provide us with additional income over and above what we would have been able to get out of just a traditional long-term corporate bond. With that, I'd like to turn it over to Stan to talk about REITs.
Thanks, Len. REITs are an area that we have been very heavily invested in virtually since the start of the firm. and they have treated us, our clients, very, very well. In discussing REITs this time and last time, however, we thought that they were looking a little on the rich side, and consequently we moved towards a REIT equivalent, which is actually a mortgage REIT, which has actually performed quite nicely during the last quarter and is supplying a higher dividend rate than the REITs themselves. With that in mind, we actually continue to not dislike the real estate area, but we did add more to the mortgage REIT so that we could actually get a little bit more return, which, as you can hear so far, and you'll continue to hear, is really kind of something that we looked at through this whole session, is how could we add return, which in effect then reduces somewhat the volatility of the portfolio. With that, I'd like to turn it back over to Len to talk about the international area.
Thank you, Stan. As Bob said earlier, the U.S. stock market we don't really think it's overvalued in any way, but we do think valuations are starting to get higher. And by certain metrics, there are people who would argue that the valuations have started to reach an area where you need to watch them and be a little bit more concerned. Internationally, valuations are much more attractive. And for that reason, we're emphasizing the international area in our portfolio. In fact, we're overweighting it above a normal allocation right now. The area we like the most continues to be Europe, and we're emphasizing Europe as well as the other developed economies, but we're emphasizing Europe by buying a fund in the 50 largest stocks in Europe and keeping that as an area that we think at this point is just poised to outperform and just has a very attractive valuation. We did discuss quite a bit what's going on in the rest of the world, including North Korea. We talked earlier in this presentation about the idea that we have triggers, and Stan is going to talk about those triggers a little bit later, but one of the triggers is, with respect to the North Korea situation, to try to make sure that we are allocated in a way that protects you in the event that something should happen there. And so we do have a provision in place to get more conservative. Stan will talk about that when we're wrapping up. With that, I'd like to turn it over to Bob to talk about some other significant changes in our holdings.
Great. Thanks, Len. With respect to our allocations and changes in our holdings this quarter, I would want to emphasize that, as with last quarter, there were no significant changes in our macro allocation. And by that I mean allocations relative to equities versus fixed income. Within the equity sector, we have increased exposure to value stocks for the last couple of quarters, and we did so in this quarter as well. And the reason for that is because we think value stocks will hold up better in a rising rate environment because they're perceived to have stronger free cash flows, and also they will be more independent of outside financing sources. So in a rising rate environment, they should do better. We added positions in healthcare and financials, largely because we believe in the long-term secular growth of healthcare. That story remains very strong, and we perceive financials as being positively sensitive to interest rates, meaning if rates go up, which we expect, banks and financial stocks as disintermediators should do better in that kind of an economy. We continue to remain underweight traditional REITs, as Stan talked about, and we remain neutral with respect to our weightings in the commodities area. With that, I'd like to turn it back over to Stan to talk a little bit about black swans and our philosophy on triggers.
Thanks, Bob. And as we mentioned earlier, we are going to talk about triggers. We have had triggers, and we've talked about triggers in these sessions many times in the past. However, we've really only effectively ever used one, because triggers are designed to not actually happen. So we're looking right now at two charts, because our current trigger is going to be related to the fact that not one of them, but both of them happening in concert will cause us to take action. The one is the core CPI. As you can see, it has not been above 3% for a very long time. So we're saying if it did go above 3%, we would have to acknowledge that something basically happened. The other chart shows the 10-year Treasury. The 10-year Treasury similarly has not been over 3% for some time. Again, we don't expect it, but we do say if it happens, then something has happened. That would cause us to pull the trigger and actually reduce our exposure to the overall markets. One thing that is different this time is we actually decided our investment going into banks this time would actually probably cause us, if rates did go up, to actually put more money into banks, because they react kind of opposite at that point. Now, the other trigger that we have, and we've again very rarely had this many triggers going at one time, but we have a trigger relative to North Korea. North Korea, if they get out of hand, clearly we want to get out and raise cash. However, the question is, well, if North Korea is going to do that, why not raise cash immediately? And that's where the black swan concept comes from. There was and there is a black swan concept which says that if no one's anticipating it happening, then it's a black swan event. Are people anticipating the possibility of North Korea becoming unruly? The answer is sure. So does that make it a black swan event? And the answer is probably not, but after 2008-9, black swan events were talked about a lot, and there were people that actually developed funds to accommodate that kind of thinking. Unsuccessfully, by the way. So we are not planning on taking any overt action, assuming that they're going to become unruly, but we will again reduce positions and raise cash if they did something, and our trigger event would be if they did something to a sovereign nation. So that would be the second trigger that we're talking about. At this juncture, again, we are relatively sanguine on the markets overall. We have taken, I think, some definitive action in case things do not go in the Goldilocks fashion that Bob's referred to. And with that, I'd like to say again, thanks for attending, and we'll look forward to seeing you again next year.